Most people think they know how much risk they can handle, but many are way off. They either underestimate their limits and miss out on growth opportunities, or they overestimate them and panic at the worst possible time. In this episode, John De Goey, a portfolio manager in Toronto who has spent over 30 years helping clients make better wealth decisions, explains why your instincts might be misleading you, how to get a clearer picture of your true risk tolerance, and how that insight can help you make more confident, effective investment decisions. Whether you're just getting started or you've been investing for years, this is a conversation you won't want to miss.
Welcome to Biz Help for You, the show that saves you the expensive learning curve by providing advice from industry experts in every facet of the entrepreneurial journey. Too many small businesses collapse. According to the U.S. Census Bureau, 20% fail within their first year, and less than 35% make it to their 10th anniversary. The goal of this podcast is to change that statistic. So if you're interested in learning more to be a successful entrepreneur, tune in today.
So, John, welcome to the show.
Thank you, Candy. It's a pleasure to be here.
I'm excited to have you here today, too. And I know a lot of people are interested in investing, and it's a little sometimes difficult with ups and downs in the market and knowing what to do. So I think this is going to be a great conversation. And we are going to talk about risk tolerance as well. But I first just want to ask you a question in general. I would love to know, what do you think is kind of the most often occurring investing mistake overall, when people are putting their money into the market or taking it out?
Normally, I would say not having a good handle on your risk tolerance, but because I know we're going to be talking about that in a moment, I'll give you maybe my second best answer, which is not knowing when to start. A lot of people that are very young shouldn't necessarily be investing because they have other expenses that they have to worry about in their 20s. They have student loans, they have to start a family and whatnot. But as soon as you start earning money and get a chance to actually have a net positive cash flow, you should be developing the habit of setting some of that money aside for much later in life. And it's very difficult when you're young and healthy and you've got a spouse or a partner and you want to enjoy life, to make those sacrifices. But that is probably the biggest single mistake that I see, is people waiting too long to start planning for when they're much older in life.
hmm Well, and I've heard that before too, is you really should start young, putting money away, even if you only are working, maybe even in high school, maybe you start a job, but maybe start putting a little of that away. But you also talked about, potentially when you're getting out of college, there may be, debt that you have to pay too. So how does someone really judge kind of, well, I have these liabilities that I owe. I do want to plan for my future. I don't know really how to balance, what is better. Can I make more by putting it in the market, still have a better return, and then slowly pay off the debt? Or should I just try to get the debt completely out of the picture and then start investing later?
It depends on circumstances. And the main circumstances are what is your expected return for whatever it is you will be investing in, and what is the interest cost of the debt that you might be incurring. Things like credit card debt are obviously bad. Credit cards are going to be charging you 18 or 20%, and you should absolutely positively pay them off entirely every month when they're due. Other things like car loans might be costing 8 or 9%. Those are the sorts of things that you should also be paying off relatively quickly, because it's unlikely that you can reliably get that kind of a return by investing. But if we have, say, a student loan that might only cost you 3 or 4%, that is the sort of thing that might not be that urgent in terms of paying it off. And if you take on debt by buying a real estate property and having a mortgage, and your mortgage payments are 3.75% or whatever, there's a reasonable chance that you can get a better rate of return by investing that money. So there's the concept of good debt and bad debt, and the real fulcrum of making the decision about whether to pay down the debt or to invest the money is to look at the difference. And one thing that I will say is that most people also tend to overestimate the return they should reasonably be expecting. So financial planning experts are saying that we shouldn't be expecting more than 6.5 or at the absolute most 7% as a long-term expected return from the stock market. So if someone says, well, yeah, but you can get double digits by investing in this or that, well, maybe, and maybe over a year or two you can. But if we're looking at debt that you're going to be paying off over the next 10 or 20 years, there's very little likelihood of getting a double-digit return in, say, even the stock market over a decade or two as a long-term time horizon. And as such, if you've got debts that are paying that are costing you, say, pick a number, 5.5 or 6% or more, you should probably be paying those debts down before you're investing money.
Hmm. Right. Perfect. Well, I did say I wanted to talk about risk tolerance today too. So I would love for you to maybe explain how can someone assess their risk tolerance before they're putting any money into the market so they know exactly where they should be investing and what they can tolerate.
The first thing that I can tell you, Candy, is that although there are dozens of questionnaires and programs out there, the very large majority of them are not particularly robust or credible. They don't do a very good job of getting a handle on what people can do. And that's because oftentimes the questionnaires, A, don't require trade-offs. So, risk and return are related. And so if you ask someone open-endedly, do you want a high return? They'll say yes. And if you ask them
Mhm.
open-endedly, do you want more risk or less? They'll say, well, less. Well, great. That would be nice if we could wave a magic wand and get a high return with low risk. But realistically, risk and return are related. And the real question that it begs is, how do we calibrate when we're taking more risk than we can properly tolerate? There's a trade-off, and risk tends to go up as return goes up. But as you get to the extreme end of the curve, risk goes up more than expected return goes up, and the trade-off is not useful to try to reach for that extra 1/2 of 1% or whatever it may be in terms of return.
Mhm.
So to answer your question, there are not many good, reliable questionnaires. I think a lot of people have an intuitive sense. On a scale of 1 to 10, most people I find are sixes and sevens. And there are some people who are truly entrepreneurial and who have both a risk tolerance and risk capacity that allows them to go further. But regulators are now taking the approach that if you're someone like me, a portfolio manager who's giving advice to retail clients, you need to think of both risk tolerance and risk capacity when you engage in portfolio construction. So risk tolerance is psychological. How much can you stand and not lose sleep at night? And risk capacity is, and even if you aren't losing sleep, are you able to pay the bills? So if you have a job
Mhm.
that is precarious, then even though you're not losing sleep about the market going up or down, you also don't have the income stream, the cash flow to pay your bills every month. Maybe you should be pulling back on the amount that you're saving and how you're investing it so that you've actually got more money that you can redeploy to stick to the knitting and do things that are more immediate as concerns. So those would be the two things. It's very difficult to reliably quantify, but when you try, you should be thinking about risk tolerance and risk capacity, and you should be building a portfolio that speaks to the lower of the two. So if on a scale of 1 to 10,
Mhm.
your tolerance is a 6 and your capacity is an 8, your portfolio should be a 6 because it should be the lower of the two metrics of tolerance and capacity.
Mhm. And I've also heard, of course, you can have more risk, earlier on in your investing years because you have so many more years to make up for it if there, are some changes and things decrease. And as we get older, we need to put things into some more secure things too. So we already know we have differences in risk tolerance overall. But do you want to touch on
I'll
maybe,
stop you there. I'll
looking at
stop.
that?
I,
Mhm.
I need to correct you there. We have differences in risk capacity. Your tolerance is the sort of thing that you're more or less born with. It's like an IQ. So your
Mhm.
tolerance will not
Mhm.
change materially over time. But you're right, your capacity, if you're 30 years old and you've got 30 years before you retire, then your capacity to withstand ups and downs along the way should be greater than a person who's retiring in 30 weeks. And so you
Mhm.
you need to think about, again, that's why I'm saying it's an important consideration, but you need to consider both tolerance and capacity, and don't
Mhm.
conflate the two. That's all I'm asking.
Right. Well, thanks for describing that in better detail for me too, because I guess misusing the word or interchanging them when you say they're totally different things. But I would love to ask you then too, what about, maybe a husband and wife who have different risk tolerances, and they're trying to figure out together, where do we put our money so that we're both comfortable and feeling like we're getting as much, growth as we can. without putting too much risk on, and someone else in the partnership is nervous?
There are two ways to answer that question. Let me go back to what I said a few moments ago, where instead of having one person having a tolerance of 6 and a capacity of 8, let's say one spouse has a tolerance and capacity of 6, and the other spouse has a tolerance and capacity of 8. The two ways of answering the question that you just asked, Candy, are one, you just build a portfolio that combines the assets because it's one family unit with tolerance and capacity at around a 7. Or you build two separate portfolios. Statistically, I don't think I'm going to be telling you anything that you didn't already intuitively know. 4 times out of 5, the higher risk tolerance capacity is the male.
Mm-hmm.
And that's just a fact, and that's not necessarily a positive fact. I think there's a lot of research that shows that women actually make better investors because they are less emotional and they build a portfolio that they can stick with. Nonetheless, if one spouse is a 6 and the other is an 8, the obvious way to try to solve the problem, assuming the portfolios are of comparable size, is to say this is all one big pot, one big family unit. Everyone at 123 Main Street is going to be living under the same roof and retiring at the same time and so forth. Let's just build a portfolio that's a 7. But if you have a situation where one spouse is adamant, no, I want to be more aggressive and this is my money and I want to do this, then you need to build a portfolio that is more aggressive for one. And the other one says, no, I think you're a madman. You need to be more conservative, and I want my portfolio to reflect my viewpoint. Both views are legitimate. And you
Mm-hmm.
have to be careful as an advisor not to take sides. It's not like there's a definitive right or wrong answer. The saying in portfolio management is the best portfolio is one that you can live with. And hopefully, if you build an 8 out of 10 risk return portfolio for one spouse, that person does in fact have the tolerance and capacity to withstand what that entails. And if you only build a 6 for the other, but that's what the person can handle and they're comfortable and they're perfectly fine, and they don't want the 8, they think the other person is just taking risks that they wouldn't want to take. That's fine too. And
Mm-hmm.
there's nothing wrong with having a husband and wife with somewhat different portfolios. That said, I will tell you that in my practice, more than 90% of the time, we split the difference and run a 7 portfolio where one is a 6 and one is a 9, one is an 8.
Mm-hmm. Okay, perfect. Like, do you see, I mean, obviously we know we're inborn with certain things, how much risk we may want to take or not want to take, but also I'm assuming that kind of the experiences that they've had growing up around finances too could affect that too. So do you see where kind of family situations have affected that, and maybe like one becomes more conservative and maybe one becomes more risky just because, well, we didn't have a lot of money, so I want to be conservative and not lose what I have, versus we didn't have a lot of money, I want to risk, and try to get more? Like, do you see kind of that dynamic going on too?
Absolutely. There's a lot of evidence that the so-called Great Generation, the people who grew up during the Depression in the 1930s, um, uh, are very good investors because they lead a frugal lifestyle, because they were ingrained. It was ingrained in them when they were very, very young, and even when they were young adults, that times were hard and that the good times might not be around the corner. And at any rate, we need to prepare for hunkering down and getting through whatever it is we need to get through. And as a result of that very searing, very real, visceral experience of what for many people might have been a decade or more of formative years of their life, that stays with them for the remainder of their life. And similarly, if you're a nepo baby or the trust fund child where you've grown up and you've never wanted for money, you act as though the money will never stop, as though it's a bottomless pit, and that also informs your thinking, your attitudes, your decision making, because once again, you've never known otherwise. And so there's no question that our socialization and our life experience will have a major impact on our attitude toward money.
Mm-hmm. So a lot of people too know they'll go to a financial advisor to help, put the money wherever. They'll just say, yeah, this is my tolerance, and it's invested for them and someone is managing it for them, and they don't really understand all the things that make up their investments and what has risk associated with versus less risk. Do you want to maybe even touch on when you're investing, kind of the risks that you have based on those?
So let's answer that. Let's dissect that by looking at it in two different ways. Two different people. You've got people who are self-directed, who do their own investing, and they just go to an online account or perhaps a discount broker or to a robo advisor, and they will either fill out a questionnaire, imperfect as it is, to get a handle and let someone else do it, or do it on their own. Or alternatively, which is what I think you're asking, if you're working with an advisor because you know that you don't know, and you would rather defer to someone who has some expertise with regard to navigating risk, but also navigating capital markets in terms of what is and is not risky at any given point in a market cycle. If in fact it's the latter, there are two ways of working with an advisor. You can, 90 some odd percent of people will work on a collaborative basis where the advisor will ask questions and try to get a handle on the tolerance and capacity and the lifestyle and the expectations. What's this money for? What's your time horizon? What's your tax bracket? So we can do what we can to tax optimize while we're at it. That's one thing. But there's going to be a small segment of the population at the relatively high end that work with people that are called portfolio managers. And full disclosure, I'm a portfolio manager, so I'm part of that segment of the market where portfolio managers are fiduciaries. They have to work in the client's best interest, and they simply do the trade. They simply buy X and sell Y, and do whatever it is that needs to be done in order to navigate the circumstances as they evolve. Hopefully, not too much trading because trading correlates negatively to performance. But they will trade as needed when needed. So the fun thing that a great way to illustrate this problem or the difference between the people who work on a collaborative basis and those who offload the decision making to a portfolio manager is by thinking about what happened in the global financial crisis of 2007 to 2009. At the time, I was a standard garden variety advisor, and I had things called an investment policy statement. So this is like a blueprint for your portfolio where we would say this, you're going to be 60% stocks and 40% bonds and so on and so forth. And I would write it, my clients would agree to it, and they would sign, and I would sign, and we would all have an agreement as to what would happen. And so the way to look at it is that, oh, if stocks drop, as they did in 2007 and 2008, well, that's a buying opportunity. And now your 60
Hmm.
40 portfolio is 50-50. So what we have to do is we have to take 10% out of bonds and buy some more stocks to bring it back to 60-40, to recalibrate our risk tolerance, and to take advantage of stocks being cheap while they're on sale. That was what we agreed to in writing. And I needed to call my clients and say, so we're going to sell some bonds and buy some stocks. And my clients are going, nah, we're not going to do that because I can't handle that. So one of the things that you have to, this is why what I was talking about at the beginning of the podcast, a lot of people don't really know what their risk tolerance and capacity is. And even if you have a middle of the road, plain vanilla, not too risky, not too conservative portfolio, people think they can tolerate things that they don't realize they can't tolerate until they're in the moment.
Hmm.
And so one of the benefits of working with the portfolio manager is that that manager does not have to call you and get you to come down from the ledge in order to execute the trades. Those trades just get made, and it will, in all likelihood, be to your benefit. And in that instance, I actually, there's an old saying that a portfolio is like a bar of soap. The more you touch it, the smaller it gets. And you have to try to minimize gratuitous trading and micromanaging and be purposeful and strategic in what you do. But you also need to be able to actually have the courage to do those strategic things that are required, even when it feels uncomfortable to do so.
Hmm. Well, while you were talking, you even mentioned, kind of when things drop, that's actually a good time to buy. A lot of people just do the opposite, right? They panic and like, oh my gosh, I don't want to lose everything, So do you want to maybe even touch on that, like why they should maybe not panic and keep things in and maybe put more in at that time?
Sure. Well, it's obvious. The four words that everyone talks about in investing are buy low, sell high. Everyone understands it intellectually, but people
Hmm.
don't have largely most people don't have the emotional constitution to actually do what it is they say they want to do because of hurting, because of group behavior, and they see their friends panicking, and it's just natural that if everyone around you is panicking, that you're going to panic too.
Hmm.
So that's why I said I thought I was being insightful by getting my clients to agree in writing, by having a pre-commitment to doing certain things, but I could not legally impose that pre-commitment on my clients, and I could not force them to do what they told me earnestly in writing they were prepared to do when the circumstances arose. So there's no easy answer to that. It's been around for time immemorial. There is a company in the US called Dalbar that puts out a study every year, and they show that most investors, whether you're working with an advisor or not, lag the benchmark, the blended benchmark. So if you've got 60-40, 60% in the S&P 500 and 40% in the broad bond index, the market and the index will get a certain return, but you, the investor, will get less than that. First off, because you're going to get a little bit less because you've got to pay fees for the product. And if you're using an advisor, you got to pay for the advisor too. But more than that, far more than that, you do poorly because of you're supposed to buy low and sell high, and study after study after study, and Dalbar has been doing this for 30 years, shows that people buy high and sell low, even though they know they're supposed to do it the other way around. So it's a human bugaboo, and there's no easy way to solve the problem. It's just something that you have to be vigilant about all the time.
Hmm. So, do you want to touch on maybe how much someone should keep in a liquid account? So if something happens, they already have cash available. They don't have to try to sell something out of their investments, maybe when it's not the best time, just for their own safety and being comfortable having cash on hand.
The standard financial planning rule of thumb is 3 months worth of salary. I think that's too high. I think you should have some, and I think it depends on, well, are there two people that are earning money in the family unit, or is there just one? Because if one loses their job, then the other could step in and they could tighten their belts and maybe be okay. And maybe instead of each of them saving 10 or 15%, neither of them saves anything because one is not working and the other is taking care of all the expenses. But that doesn't require usually as much of a cushion. Most
Hmm.
people, if you own a home, most people can get a line of credit secured against the equity in their home. And for those people who have a line of credit against their home, and even there are some people who will even maybe not have a home, but will have a strong income and cash flow and credit rating, can get a line of credit that's just available in their hip pocket. It can sit there for 5 or 10 years and you never ever use it, but you've got access to, pick a number, $25,000 that you can get at a low interest rate if you need it. Hopefully you don't need it,
Hmm.
but rather than having $25,000 earning next to nothing in a daily interest savings account because you can get at it, on a moment's notice, and then paying tax on that return and really taking home next to nothing and actually losing money after inflation. I would rather people have a smaller amount of money for those sorts of emergencies, maybe $8,000 or $10,000, and then have more money set aside for through a line of credit, through an access to a credit facility at a reasonable cost if you need it. And if you go through your entire life without ever using it, that's good. It just means you didn't have an emergency, although that would be relatively rare. Most people, most of the time, have some emergencies that crop up eventually.
Hmm. I would love for you also to touch on whole life insurance because I've heard too, you can purchase that and then you can use that money. It's kind of in an investment too, but you could use that money if needed, take it out as a loan if necessary. I would love for you maybe to explain what that is, and how it could work.
I don't like it. So I can explain to you how it could work, but I'll begin by saying that most people, and I'm going to say well over 90% of the people that I meet, would be better off just buying term insurance and investing the difference. And so that way, insurance performs its role. It's an important role. You need to insure against premature death. If you're the sole breadwinner in the family, and you've got a spouse and children that are depending on you, and your spouse isn't working, and your children haven't gone through school, and you've got a $400,000 mortgage or whatever else, you need a lot of insurance, maybe pick a number, maybe $1 million worth of insurance, uh, to protect your family, your loved ones, in case something tragic, if you get hit by a bus, something tragic happens and you lose your life. All of your assets are predicated on your earning potential, and that disappears like that, and then you need to protect against it. So you certainly do need insurance. What you don't necessarily need is whole life insurance, where you overpay and put too much money into insurance and less money into other things, just so that you can draw it out at a later point in time. Yes, you can draw it out. Yes, you can grow tax free. Yes, it will pay out down the road. But most people, not everyone, but most people would rather have the insurance for its traditional role, which is to pay off any debts that might be incurred by the family unit while they're incurred. You're self-insured. By the time you're, pick a number, say 60 years old, you're getting close to retirement. You've got, pick a number, $1 million set aside in your nest egg. Your kids have gone through school. Your mortgage has been paid off. At that point, if you get hit by a bus, while it'll be emotionally and psychologically tragic for your surviving family members, financially they'll probably be okay, because the debts are no longer there. The obligations have already been met, and there's a big enough pool of capital that's been built up that you don't need it. So in most instances, buying term and investing, the difference is the better way to go.
Mm-hmm. Perfect. Was there anything else regarding kind of the risk tolerance that you want to talk about that I didn't know to ask a question about?
Uh, Wow, that's a great open-ended question, Kenny, and I'm going to see if I can think of something. So here's what I'll say. People oftentimes, and I'm sure you've heard people talk about this, but we haven't talked about it explicitly on this podcast, is you should diversify. Diversification is the best thing that's out there. So diversifying within and throughout asset classes. That's not, when you say stocks, not just stocks, large companies, small companies, domestic companies, foreign companies, bonds, not just government bonds, but also corporate bonds and municipal bonds and what have you. And in other things, other asset classes that you might be able to invest in a judicious manner. Real estate, both private and public. There are things called real estate investment trusts. I'm not necessarily talking about your principal residence. You can buy real estate as an investable asset, just the way you can buy stocks and bonds. And it's good because they have different risk return characteristics. You should consider maybe any structured products and things that are good inflation hedges, things like gold and commodities. Again, judiciously, I'm not suggesting betting the farm, but putting a little bit of money into a large number, a wider variety of things. The fancy pants finance term is covariance. You're trying to find things that zig when other things zag, so that
Mm-hmm.
if everything in your portfolio is going up at the same time, you're probably doing it wrong. You want to have something. If you have 6 or 7 different kinds of investments, it's very rare for all of them to be doing well. And if 1 or 2 of them are doing poorly, that's still not so bad, because the other 5 or 6 are doing well. But then in a different market cycle, some of the ones that are doing poorly will be doing well, and the ones that are doing well will be doing poorly. And what that does is the highs are less high, but the lows are less low. And
Mm-hmm.
there's a lot of research. There's a guy by the name of Daniel Kahneman, who he and Amos Tversky did some research on something called prospect theory. Kahneman ended up winning the Nobel Prize in 2002. And prospect theory shows that people feel the pain of a loss twice as acutely as the joy of a gain. So when you're starting to talk about risk tolerance and risk capacity, a big part of building a portfolio you can stick with is minimizing major drawdowns. And if you can diversify and build a portfolio that doesn't drop as much when your neighbors are dropping, you might feel bad that you're only getting 6 or 7% when your neighbors are getting 15. But if you're getting 0 when your neighbors are losing 10, you might be feeling a lot better about, hey, my portfolio might not have shot the lights out on the way up, but it also didn't get hammered on the way down. And I understand that trade-off, and I can therefore stick with it. And because it'll be your friends that are boasting at the cocktail party about the 15% return when you're only getting 6 or 7, that will also almost certainly be bailing when they're losing 10% and you're not losing anything. So if we're
Mm-hmm.
trying to find a way to engage in what might be a hack, to know yourself, to engage in preemptive behavior modification, to build a portfolio that will protect you from your own worst tendencies, that's a really, really good thing to do.
Perfect. Well, I know this has been informative. I'm sure, the listeners will have learned a lot just from this discussion, but I know our time together is coming to an end today. So I wanted to ask, do you have an offer that you would like to extend to our listeners? And if they want more information, how can they contact you?
Candy, as fate would have it, I have a podcast of my own, and my podcast is called Make Better Wealth Decisions. So, Make Better Wealth Decisions is available on all platforms. It put out an episode every Thursday, and I speak to people throughout the wealth management industry and journalists and regulators and product manufacturers, and we talk about some of these things. We talk about decision making within wealth management, and there are a lot of behavioral quirks that we all have to deal with, which is part of why I'm so glad to be able to speak to you today. But I get a chance to discuss the same sort of subject matter every Thursday, and it's a lot of fun. So that podcast is called Make Better Wealth Decisions.
Perfect. Well, thank you, John, for being a guest on my show. Again, sharing your wisdom on this topic. I greatly appreciate it.
My pleasure. Thank you, Candy.
Mhm. And to the listener, if you enjoyed today's topic and you want to hear additional information, you can find access to exclusive content in the show notes. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help for You. Please join your host, Candy Messer, again next time. Have a terrific day.